everyone, welcome back to my channel, where I dive deep into the world of finance to bring clarity and insight right to your screen. Today, I am tackling a topic that mystifies many but is crucial for making seamless transitions in real estate: bridge loans. Imagine you found your dream home, but there's a catch. You need to purchase it before selling your current property. Enter the bridge loan, a solution that sounds simple but comes with its complexities and nuances. You've got questions, and I've got answers. One of the most common questions I get is, what happens if my property doesn't sell within the bridge loan term? A valid concern indeed. If the original property doesn't sell in time, you might need to explore options like extending the bridge loan or securing alternative financing, which could affect your financial planning. There's a lot to unpack with bridge loans, and I am here to guide you through every step. Stay tuned as I break down the essentials, share expert advice, and provide real-life case studies to help you decide if a bridge loan is the right choice for you. What is a bridge loan? A bridge loan is a short-term financing solution that helps you cover costs until you secure more permanent financing or clear existing debts. Often referred to as swing loans, these are usually short-term, lasting from 6 months to a year. They are particularly useful when you want to buy a new home but haven't sold your current one yet. Many people prefer to have their current home sold or at least under contract before they make an offer on a new place. This strategy helps them use the proceeds from their sale to fund the purchase of their new home. However, if selling your home is taking longer than expected, a bridge loan can provide the funds needed to proceed with buying a new property. This type of loan is handy for homeowners who need to move quickly and want to bridge the financial gap between selling an old home and buying a new one. If you're looking to buy in a competitive market, having a bridge loan can also help you make an offer without having to wait for your current home to sell. It's important to note that a bridge loan isn't a substitute for a traditional mortgage. It's meant to be a temporary solution, typically paid back within 1 to 3 years, and it falls under the category of specialty financing rather than standard mortgage options. How do bridge loans work? A bridge loan is a handy option in real estate, especially when you're eager to make a down payment on a new home but your current home hasn't sold yet. Here's a simple breakdown of how it works. Option 1. Include a sale contingency. You can make an offer on a new house with a condition attached that the purchase will only go ahead once your current home sells. This is known as a sale contingency. However, this might not be the most attractive option for sellers if there are other buyers who don't have the same condition and are ready to buy immediately. Option 2. Use a bridge loan for the down payment. Alternatively, you can take out a bridge loan. This loan allows you to use your existing home as collateral and provides you with the funds to make a down payment on your new home right away. Typically, lenders might offer you a bridge loan that covers up to 80% of the combined value of both properties. Bridge loans aren't just for individual homeowners. Businesses also use them to manage cash flow and cover operational costs like utilities, payroll, and rent while they wait for more permanent financing. Distressed companies might use bridge loans to keep things running smoothly until they find a major investor or buyer, with lenders sometimes taking an equity stake in the business as security. So, who offers bridge loans? Bridge loans are specialized types of loans provided by various lenders, but they're not as widely available as standard mortgage options. While you might not find a plethora of options through a simple Google search, there are numerous specialist lenders and some private banks that offer these types of loans. Specialist lenders and private banks. Companies like Together Money, United Trust Bank, and other specialist financial institutions frequently offer bridge loans. These loans are tailored to fill the gap between transactions, particularly in real estate or business acquisitions. Working with mortgage brokers. Due to the specialized nature of bridge loans and the nuances of the lending market, many individuals and businesses benefit from working with a mortgage broker or a specialist bridging advisor. These professionals are deeply familiar with the market and deal with bridge loans on a daily basis. They can guide you to the right loan structure for your situation and connect you with lenders who offer competitive rates and terms. Brokers understand the intricacies of bridge loans and can advise you on the best approach. They can negotiate on your behalf to secure favorable interest rates. Brokers can streamline the application process, making it quicker and less stressful. Current trends and offers. As of recently, Lenders like TSP have been adjusting their loan offers, with some reducing their fixed rates to make borrowing more attractive. This indicates a competitive market where terms are continually being adjusted to attract borrowers. Bridge loan requirements. Here's a breakdown of common eligibility requirements and considerations for obtaining a bridge loan. 1. Credit score and financial health. Lenders typically require a good to excellent credit score for a bridge loan approval. This demonstrates to the lender that the borrower has a history of managing credit responsibly. Your financial health, including your debt-to-income ratio, will also be scrutinized to ensure you can handle the additional debt load. 2. Collateral. Bridge loans are secured loans, which means they require collateral, usually in the form of real estate. The lender will assess the value of your property to determine the loan amount. 3. Income requirements. Lenders will review your income to ensure that you can meet the loan payments during the term of the bridge loan, especially since you may be handling payments for 2 properties if your original home hasn't sold yet. 4. Use of loan. The funds from a bridge loan are typically used to finance a new property purchase before the sale of an existing property. However, the specific use of the loan might need to be detailed in the loan application. 5. Specific lender requirements. Some lenders might have unique requirements based on the loan product or the borrower's circumstances. For instance, certain bridge loans might be available only for specific types of properties or for properties within certain geographical areas. 6. Additional financial assistance. In some cases, such as with the Alternative and Clean Energy Program, ACE, bridge loans or similar financial products might come with the option of grant funds, which can aid in meeting the costs associated with the project or purchase. Application process. The application process for a bridge loan typically involves a detailed scrutiny of your financial situation, including credit history, income, and existing debts. You might be guided through this process by a financial advisor or the lender's own specialists. What are bridge loan rates right now? As of April 2024, bridge loan interest rates and related costs vary but generally reflect their short-term, higher-risk nature. Here's a summary of the current rates and fees associated with bridge loans. 1. Interest rates. Bridge loan interest rates are notably higher than those for traditional long-term mortgages due to the increased risk perceived by lenders. Rates range from 0.55% to 1.5% monthly, which translates to an annual rate of approximately 6.6% to 18%. 2. Arrangement fees. Lenders typically charge an arrangement fee for bridge loans, which is an upfront cost added to the loan. These fees range from 1% to 2% of the total loan amount. 3. Exit fees. Some bridge loans do not have exit fees, especially on certain products. This can reduce the total cost of the loan if you are able to repay it early. 4. No minimum term. Bridge loans offer flexibility in terms of repayment, with no minimum term in many cases. This means the loan can be repaid as soon as the borrower's finances allow, even after just 1 day, without additional penalties for early repayment. 5. Impact of U.S. Treasury rates. The 5-year U.S. Treasury rate, which is currently at 4.66%, serves as a critical benchmark for pricing many types of loans, including DSCR loans. While not directly correlating to bridge loan rates, this benchmark reflects the general borrowing environment and can influence interest rates indirectly. Risks of a bridge loan. Bridge loans, while useful for bridging financial gaps, especially in real estate transactions, come with several inherent risks that borrowers should consider. Higher interest rates. Bridge loans typically have higher interest rates compared to traditional long-term financing options. This is due to their short-term nature and the higher risk associated with them. Higher rates mean higher monthly payments or a larger interest bill if the loan term extends beyond the expected period. Dual mortgage payments. If the original property is not sold before the purchase of the new property, the borrower may end up paying two mortgages simultaneously, which can strain financial resources significantly. Short repayment period. Bridge loans require quick repayment, usually within 12 months. The pressure to secure longer-term financing or to sell the existing property can be significant and stressful. Dependence on property sale. The repayment of a bridge loan often hinges on the sale of the borrower's original property. If the property does not sell or sells for less than expected, the borrower may face financial difficulties. Impact on credit score. Failure to meet repayment obligations on time can negatively affect a borrower's credit score. This could make future borrowing more difficult or expensive. Refinancing risks. Some borrowers may plan to refinance the bridge loan into a more permanent form of financing. However, qualifying for refinancing can be uncertain and depends on the borrower's financial situation at the time of refinancing. Market risks. Real estate markets are unpredictable. Changes in market conditions can affect both the sale of the existing property and the value of the new property, potentially complicating the financial arrangements. Risk of over-leveraging. Taking on a bridge loan increases the borrower's level of debt. This over-leveraging can be risky if the borrower's income or financial situation changes unexpectedly. Thanks for watching, and see you in the next video.